Hello and welcome to lesson 1. We're going to be talking about pips, their values and the position sizing you should be going along with it. Now, as we get right into it, I just want to talk about different account types. First of all, there's 3 different types you can have. First of all will be the base level up the top there, that's a macro account. Now, as we progress down, the volume sizes get a lot larger. So, if we start from the top, if you're a beginner, you want to open up a macro account. What you're going to be looking at is initial deposits of the very lowest being $100. I would start off with $1,000 to be honest. So you've got good flexibility into your account fluctuations. But basically what to expect with a macro account is for every one full lot you're trading a $1,000 contract, which means you've got $1,000 of somebody else's money in the market. Depending on how much leverage you've got will determine how much money you've actually got in the market. But anyway, 1 pip on a macro account is equivalent to 10 cents, okay, for one full lot. Now, what I always refer to on these courses, I'll be using the mini account. I like the mini account, it's got good flexibility. You can trade small position sizes, but you can also trade multiple large position sizes, all relative to the amount of money you've actually got in the account. So on a mini account, with one full lot, you're actually trading a $10,000 contract in the market. Every pip value is worth $1. Okay, nice and simple. And standard accounts, these are for the professionals. I tend not to use it just because of the large position sizes. I like to use smaller contracts, to be honest. So in a standard contract, you're looking at $100,000 in the marketplace, and every pip is worth $10 at one full position. Okay, so we're going to be using mini accounts. That's what my explanations will always be about. So what is a pip? Let's get into it. Pip is a price interest point. It is one single movement which a market makes. It is less than 1 cent. In fact, most pairs have 4 decimal places, which means there are 100 pips in every cent of price movement in the exchange. If we look at the Euro US dollar chart here, you'll see the valuation is at 1.35278. Okay. What this means is you get 1.35 euros to $1, because the Euro US dollar here, Euro is a base currency against the US dollar, so the price you see here is always euros and it's relevant to the dollar, but you get 1.35 to the dollar here. So €1.35, and then the next 3 numbers are less than cents, so decimal places. Okay. Now, once you get past the 4th decimal, you're talking really small numbers. I'm not even talking half pennies or quarter pennies anymore. A couple of years ago, they only used to run with 4 decimal places. Now they're running with 5. It gives a lot more accurate pricing. Instead of moving half a pip, it can now move in increments. So I tend to forget the last number at the end. It's the same as when I get my crosshair and if I estimate pips, I always forget about the last number on there. So right now we can see the middle numbers, 233 and a 0. Forget about that 0. So it's actually 229 there. I say 0.3. Okay, little explanation. So when I talk pips, we're talking one movement on the 4th decimal place. I know it might sound a little bit complicated, but if we open up a new order window, you can see how it's priced here. 1.3526 and then the very small 8 number. The 8 is a fraction of a fraction, okay? So we only count 4 decimal places here. And this one right here, the 4th decimal, that's 1 pip. Okay. So when you go to the exchange and you see the price as for your euro, US dollars has changed by just 1 cent at the checkout, on the markets it's actually moved up 100 pips. So you know that's quite a dramatic change for only a cent at the exchange counters that you get in your post offices and banks. This is because we use leverage products. When you get your broker, your account's always leveraged 50 to 1, 100 to 1, 400 to 1, whatever you choose. This gives us more flexibility into generating profits or losses faster by using the broker's money to put up a larger portion, and with only $1,000 in the account you can trade a $10,000 contract. It's a good thing about leverage, but just don't have too much. Okay, so we'll jump over to my Excel spreadsheets just now. Just want to talk about this part right here. This is off my money manager spreadsheet that I've got on the website. Now these are pip values priced on a mini chart and one full lot. So the prices today, as you can see, some of the major pairs here: Australian dollar, US dollar, Euro US dollar, and Great British Pound US dollar. They are all priced at $1 each per pip, which that's fairly straightforward. When we get into the crosses with the Japanese yens, value actually goes down a little bit less than $1. It's actually 98 and a third cents. Now these values do fluctuate as the charts go up and down over the months. I saw the Great British Pound Euro being at 1.47 before. So what this means is, if you were to place a trade and on the initial, let's just say Great British Pound US dollar, you risked 30 pips, you would only lose $30. But when the pip value increases to 1.5, you've now just lost $45 instead of 30. Now it might not sound an awful lot, it is another 50% onto your loss, but if you do that over time, it can add up to quite a lot. So quarterly, 4 times every year, I'll go and check my pip values and just keep them up to date on this spreadsheet. Okay. Now we're talking about position sizing. We're just going to assume that a balance of $1,000 in here. Okay. And I've chosen a leverage amount. This is the leverage I use, 10 to 1. This means for every $1,000 in the account, I'm trading a $10,000 contract. Now, if you're starting off, we can usually go to 5 to 1 leverage, which basically halves all the position sizes. But I like to keep it at 10. Beginners choose a 2 to 1 until they start gauging whether they can actually strike any winning trades in the market. Now I always risk 3% on my trades, maximum, not a penny more. And these numbers are all relevant to my position size. Excuse me. Including of the pips at risk, there's a formula built into here which will give me my accurate position size on the maximum amount that I would expose to the market at any one time. So a 3% risk on $1,000 is $30, and dividing that by 30 pips, which is my maximum for any trade at full leverage, would be one full mini position size. Now, if I were to come across a trade where it was at 40 pips, I would need to half my leverage via the position size and double the amount of pips that I need to put on the trade. Okay, so if I had a 45 pip, I would half my position size, double the value of the pips at risk, but in time not risking any more dollars on the market. Okay, we can talk a lot more about this later on in other videos, but this is a brief description. Just want to talk about percentage of risks, because I know what a lot of you might be thinking. 3% doesn't 3% doesn't really sound a lot. You probably want to start off because you see some people advertising on the internet risking 5% per trade. Now, just want to go through these little formulas. Starting off in the $1,000 account balance, as before. Just want to state that a 2% risk is a $20 loss. Okay, doesn't sound a lot. That's all good. 3% risk, as we talked about, is a $30 loss. 5% risk equals $50. $50, and a 7% risk was $70. Now, each one of these losses, when somebody's got $1,000, you might think, okay, I could probably stomach that once or twice up at these higher levels. But the sum that I've got in here is to work out how many trades you can lose $20 starting with $1,000. Okay, so let's say you're starting out and you're coming across a new system and new money management, position size, and you're just trying to figure out the market. You're probably going to lose a lot. Okay, trying to strike a winner is going to be a big deal for you. So only risking 2% on the market, $20 a trade, this can happen 50 times before your account completely disappears. Okay, a 3% risk, which is my maximum, and I've been trading for years. This will give you 33 1/3 times to lose before your account goes to zero. Now, what a lot of people will do is they'll choose this 5% because it's nice. Lose $50, win $50, win 100. It's a nice round number, 5%. It's a bit easier to work out than other formulas. But what this only gives you is 20 times you're allowed to lose before that $1,000 just disappears. Now that's not really a lot. I've had losing streaks of 20 plus trades, and that's just through normal market conditions sometimes. So as a newbie trader, those 20 pips, 20 trades, they'll just go in no time at all. Okay, and at this 7%, if somebody were to choose that, which is, it will be completely absurd. That's a fast track to ruin. But 14 losses in a row, and that's it. You'll be wiped out. And it doesn't even matter if you've got a $10,000 account. If you do that, you still lose 14 times, and all that money's gone. You can have 100,000. Right? You risk 7%. You lose 14 times. You're done. Pack your bags, go home. Okay. So all the zeros on here doesn't matter. It just adds more zeros here. But it's all down to the percent the risk per trade. Now, if you're a beginner, 2% please, okay, no more. This will give you good flexibility to keep yourself going in the market for a little bit longer. It's all about staying alive, staying in long enough so you can learn all the tricks of the marketplace, okay? When you get consistent, take yourself up to 3%, okay? But never ever ever risk any more than these. See all this? Delete it, forget about it. Beginner and intermediate, pro, whatever, okay? Alright, okay, so we talked about pips, their values, and talked about some position sizing. Okay, so when we go to the charts on the next videos, we're going to be talking about spreads and what are the bulls and the bears. Okay, so I hope you enjoyed this video, and we'll look forward to the next one. Thank you.